Hello, my name is David Butler and I'm the Head of Charities and Not-for-Profits at Bishop Fleming, and I'd like to welcome you to the latest in our series of charity webinars. And who knows, maybe this will be the last session we have to do virtually and the next one will be in person. We have a packed agenda for the next 45 minutes, so I'll only take up a minute or two of your time to go over the housekeeping. As with all webinars, we have a Q&A session at the end, and so if you've got a question, then please submit it via the Q&A option. Depending on what device you're on, somewhere on the screen there'll be a Q&A panel, so if you could enter your question there, that would be much appreciated. As I said, we'll have a Q&A session at the end of the presentation, but we'll do our best to answer all the questions today. If you don't get around to yours, then we'll answer after the event, and we'll send you the full Q&As and a link to the recording and some other useful resources. So all that will come after the event, but as I say, we'll do our best to answer your questions. It would be something of an understatement to say that the last year or so has been a bit challenging for the sector. Some charities are emerging stronger than ever, but most have had to make some difficult decisions about how to effectively fulfil their charitable purposes and balance their budgets. We hear a lot of talk about a return to normality, but my view is that things are never going to be the same again. Hopefully, however, we are entering a period where there's a bit more certainty for the sector, and that makes it much easier for charities to plan. The pandemic has given charities time to reassess and reevaluate what they do and how they do it, and this has had an impact on their strategies. One of the areas that many organisations have thought about is property, be it offices, retail space or other space. Do we need to use as much space? Can we work from home? Is the space in the right location? Can we get something cheaper? So property is an issue for every organisation, be them charitable or not. Therefore, we've designed this session to help you with those discussions and plans and any subsequent changes that are needed, and also to help you understand the opportunities and pitfalls. We're going to start off by hearing from Ashley Phillips of Bruton Knowles, who will give us an overview of the property market and current trends. We'll then be hearing from my colleagues Wendy Andrews and John Sparks on the tax and VAT issues associated with property transactions, whether you're buying, selling or refurbishing. Ben Thorne will then talk to you about accounting and governance issues around charity property. And then the final session, you'll hear from Rory Trounce and Tim Walmsley of Stephen Scown, who will give a legal perspective of some of the challenges around charitable land and property and the risks it can present. So without further ado, I will hand you over to Ashley.
Good morning, and thank you, David, Bishop Fleming, for inviting me to talk at this webinar this morning. My start, I'm going to be covering current property market conditions in the main sectors, and then a refresher on business rates issues as they apply to charities. So let's firstly look at the retail market, normally of relevance to those who operate charity shops, and the retail sector has had a torrid time over the last few years, which has been exacerbated by COVID. In the last 15 months, city centres throughout the UK have seen falling rents, increasing vacancies, significant rent arrears, and tenants protected by the moratorium. We have seen a divide between essential and non-essential retailers and their performance. The COVID pandemic has essentially compressed 10 years of retail change into the last 15 or so months, and we are unlikely to see a substantive reversal. There is an excess of retail estate across the UK. During the pandemic, we have seen differing performance in rents and voids between the high street and neighbourhood and local parades where rents are more modest. It goes without saying that social distancing is going to adversely impact on retail and hospitality operators as long as this remains in place, either mandatory or voluntary. This will cause issues on turnover, profitability, tenants' ability to continue to trade, and ultimately rental levels. Parking also remains a key issue within retail. Parking costs have been brought into sharp focus by consumers given the ease and the accessibility of online shopping, whilst pre-pandemic there was already a move towards retail as a more leisure-based activity, and again it may take some time for this to recover. So moving on to the industrial sector, this has been the best performing sector over the pandemic period with record investment. As the slide shows, some 11 billion has been traded in the last 12 months. There has been an increase in rent and capital values across the UK and a general shortage of stock within the market. The market has been driven by the industrial and logistics sectors, online shopping, healthcare and general manufacturing, requiring premises from the big box to small units located in towns and villages, which are now operated by e-commerce startups, last mile delivery operators, as well as general manufacturers, both big and small. There is an impact on Brexit, but this has been mixed and has been thrown into sharp focus by the pandemic. Some operators have continued to deliver well through Brexit, whereas clearly that has had an impact on other occupiers. Moving on to the office sector, and to pick up on David's point in his opening, the office sector really is in a bit of a state of flux at the moment, and the current trajectory is as yet unclear. The work from home guidance remains in force, and whilst there's been a slow return to the offices in the regions, a significant number of employees are still working at home, and there is a debate as to whether this model will become the normal going forward, with various commentators and CEOs offering differing predictions. The likely impact from an occupier's perspective, however, is that there will be a scaling back of the general office footprint across the UK by some 5 to 15%. As such, an increase in available floor area is likely, and this churn in office property is also likely to lead to a flight to quality, with older, unmodernised stock being unlettable or recycled into other uses, typically residential, sometimes hotel use. However, the trends in the office sector are less reactionary than retail, but in our view, this is still a sector which may see some moderate short-term stress. Finally, the residential market, which has been well reported in the general press in recent months, but some takeaways on this sector are that the current market has been driven to all-time highs in terms of value, despite the initial fears after the first lockdown. Fundamental drivers in the short term are the stamp duty holiday, which, as people will be aware, is due to end partially tomorrow and partially at the end of September. But fundamentally, there remains a demand and supply imbalance in the market. Demand remains strong, supply is extremely restricted, both in terms of new build and pre-owned stock. The RICS market prediction is that activity will soften in the autumn of 2021, but there is unlikely to be a reduction in values beyond any adjustment for the stamp duty. The cladding crisis is likely to have a significant impact on the market in the next 2 to 3 years, as the costs of rectification are now becoming more evident and are substantial. Property rental values in the residential sector have risen approximately 3% in the last 12 months outside of London, and we see no reason for that to continue. Again, a shortage of supply exists in the residential market. And finally, some business rates issues for charities. It's a somewhat complicated system given the exemptions and reliefs that are available, and I'm sure many operators are aware of the standard reliefs, and these are 80% mandatory relief, which should be applied automatically by a billing authority, and a top up of 20% discretionary relief, which is now far more rare than it was perhaps 3 or 4 years ago. The key takeaway here is that the property must be occupied wholly and mainly for charitable purposes. Empty properties owned by charities are entitled to 100% relief, but where the next use is charitable. A lot of billing authorities do not necessarily pick up on this and will grant charities 100% relief, but the rules are that the next use must also be charitable to benefit from that full relief. A slight twist on charity shops: the relief is only available if the shop is wholly or mainly used for the sale of donated goods. Figures of 10 to 20% have been banded around by various local authorities or billing authorities. So an important point to consider there. From our point of view, working with a number of charities on their business rates, we recommend that charity occupiers should monitor their bills closely with the COVID expanded relief that has been available, as well as COVID grants, which have been in contradiction to the standard charity reliefs, it is important to have checked that the right relief and the maximum relief has been applied for, and that the grants have been claimed. And a final word from me on charities being used for rates avoidance. If the scheme or the use is not genuine, it will likely come under scrutiny. The Peace SCT case, which was a charitable Bluetooth occupier who operated about 2,000 locations throughout the UK, was deemed to be a scam. It was not deemed to be occupation for wholly or mainly charitable purposes. The company ended up in liquidation. The directors are under criminal investigation, and the occupiers, or the owners rather, of the buildings were then forced to pay the rates. So again, charitable occupiers are often used on short-term bases to mitigate rates. If you are involved in that sector, please ensure that the charitable use which is being used is legitimate. And that's the end of me, so I will hand back. Thank you very much indeed for listening.
Thanks very much, Ashley, and good morning, everyone. As David said, John Sparks and I are going to spend 10 minutes talking about some of the key property tax issues for charities, me on VAT, John on corporation tax mainly. And I would say property can be a huge issue for charities. Charities VAT rules in particular are complicated at the best of times. The property VAT rules are also complicated, and typically a property transaction will be a high value transaction. So those three things combined can make it a very important consideration if you're involved in a property transaction or planning one, to be thinking about the VAT and tax implications. So the way we're going to look at this, I've kind of selected the three key moments when a property will be of particular importance, or its tax treatment of particular importance to a charity, and that starts with when you buy a property, if you refurbish a property, and lastly if you sell a property. So those are the three key areas that John and I are going to have a look at. So firstly, buying a property. The key first question to be thinking about, if that's something that you're thinking about considering as a charity, is will VAT be charged on the property? And I think it demonstrates how complicated the VAT rules are for property, that there are a number of different answers to that question. First of all, you might not be charged VAT, which is obviously a good starting point. That could be for one of two reasons. Either your purchase is exempt for VAT, and that is the default VAT treatment of a commercial property transaction, so that's possible. Secondly, your purchase could be zero rated for VAT, and typically that'll happen if you're having a new building constructed for your non-business or for some sort of residential use. Important thing to remember if you're buying a zero rated property is that that zero rating is dependent on your use of the property continuing to be the same for a 10-year period. So really important to be aware of that and monitor it. Second option for VAT treatment is that you're making a purchase with VAT, and typically that will be because your seller, the person you're buying from, has decided to opt to tax, because the thing that makes property VAT particularly complicated is the existence of the option to tax, which means that someone who's selling a building has a potential choice about whether to charge VAT, which will usually be driven by whether they need to claim some VAT back or not. So if you are buying a property and the seller has opted to tax and is proposing to charge VAT, the next thing to consider is whether you can actually get the seller to disapply their option to tax, because there are some specific property related VAT rules which mean that for a charity who's going to use a building for a non-business activity, so a non-income generating activity typically, you can ask the seller not to charge VAT for their option to tax not to be effective. And that's something you're likely to want to consider doing. It might have implications for the seller. They might need to increase the price to include some VAT they can't claim, but always worth thinking about. And the final option for buying a property is you might buy it as a transfer of a going concern. And typically that applies when you're buying effectively a property letting business rather than a building. And that's usually a building or buildings with tenants actually sitting inside it at the time. And that means that even if there's an option to tax, it's possible to treat the transaction as a transfer of a going concern. So you won't be charged VAT, but there are certain conditions, including the main condition that you'll need to be VAT registered, and you'll need to opt to tax that building in order to purchase it free of VAT as a transfer of a going concern. So those are the main options for how the purchase might be treated. And then on the basis that you are incurring VAT on your purchase, the next big question, of course, is can you claim that VAT back? And the key issue there, which determines the VAT reclaim position, is what you're going to use the building for. If you're going to use the building to make taxable supplies, for example, as a charity shop, then it's possible you'll be able to reclaim at least some of the VAT. If you're not using the VAT for any sort of for any sort of taxable use, then potentially you can't claim any of the VAT. And if you're going to have a mixture of taxable use and exempt or non-business use, then it's likely that your partial exemption method will determine how much VAT you can claim. Other things to be aware of, particularly in any property transactions over £250,000 on which you're being charged VAT, and that's the capital goods scheme, which means that you can't just determine the VAT recovery in the first year when you buy the property. You have to continue to review the use of the building and adjust VAT recovery for a 10-year period. So those are the key VAT issues around buying a property. I'll hand over to John to talk through some corporate tax issues.
Thanks, Wendy. Good morning, everyone. The key corporate tax issue that we need to think about really on purchase is which entity within a charities group, if it's got a group, is going to be the one that's going to be buying the property. More often than not, the answer is driven by what the property is going to be used for. And more often than not, the answer is likely to be that it's going to be purchased in the charity. That links to a number of tax issues, stamp duty, land tax relief in particular, where relief from stamp duty for the purchase is given where the property is going to be used wholly or mainly for charity purposes. So it's very similar wording to the business rates example that Ashley mentioned earlier. As far as stamp duty land tax is concerned, the relief does also include a situation where you're buying for investment purposes, so to let out in order to generate revenue. The other thing that can drive which entity is sometimes if it's going to be used, for example, partly by a trading subsidiary. More often than not, you don't want to have the property purchased by the trading subsidiary because that will be a blocker or potential blocker for the efficient working of gift aid for the trading subsidiary. One last point around purchases is not to forget capital allowances. Obviously, if we're buying our property within the charitable entity, then we've got an exemption over any rental income that's going to be received. So actually, we don't need to be considering claiming capital allowances ourselves. However, what you don't want to do is ignore the capital allowance history of the property, especially if it's a new build, or if you're buying it from a third party. Because if and when you come to sell that property and you cannot demonstrate the capital allowance histories and you haven't signed the relevant elections, then that's an area where a purchaser could potentially chip away at the price on sale if they're not able to access capital allowances on a building. So that's especially if they're a commercial buyer of that property or a non-charitable buyer. So those are the main issues really to consider in buying a property. Wendy's now going to pick up some VAT thoughts around refurbishment.
Thanks very much, John. Yes, in the case where you're refurbishing a property which you own, the VAT issues are similar in principle to buying a new property. How much VAT will you incur? Will you incur VAT, and can it be reclaimed? Slightly different range of possibilities on the being charged VAT front. On the basis that you're going out and incurring construction costs from a contractor, then it's likely the default position is that VAT will be charged at 20% by the contractor. But there's just two specific cases to be aware of. First of all, there are some zero rates of VAT for some construction services, particularly around adaptations for disabled people, for example, around bathrooms and around ramps for access and widening doorways. So one thing that that can be worthwhile is if you're doing a big refurbishment project, is to pull out the elements of that project which do qualify for 0 rating for things relating to disabled people, because your contractor can then identify those costs and not charge you VAT just on that part of the cost, which, if you're not going to be able to recover VAT or very much VAT on the whole project, can be an important VAT saving. Second rate of VAT that you could be charged is the 5% reduced VAT rate, and that applies to construction services generally where they relate to residential property, where they relate to the refurbishment of a property that's been empty for more than 2 years, to the conversion of a non-residential building into residential use, and for work on a property which is going to change the number of residential units. So the conversion of a house into flats, or a flat into a house, would qualify for a 5% VAT rate. And again, if the VAT's not going to be recoverable, really important to make the benefit of those reduced rates if you can. Those are the main exceptions, though. Most other construction work that you incur will be subject to VAT at 20%. And the question about whether the VAT can be claimed is the same as the question on buying a property, depending very much on the use of the property. And also always remembering that if you have a refurbishment project that's over 250,000 plus VAT, that project will also fall within the capital goods scheme. So the VAT recovery you have in the first year will need to continue to be monitored for a 10-year period. I wasn't sure if John has a quick comment on refurbishments or whether I should just go straight on to sales. He's shaking his head. So next slide, please, then, John. Thank you. And we'll move straight on to the last point, which is around selling a property. Obviously, different VAT issues when you're selling the property, because you have to decide as a VAT registered property owner whether to charge VAT on the sale of the building, and that's likely to perhaps kick back to what you did when you bought the building. If the building has never had any involvement with VAT, if you bought it without VAT and you've never opted to tax, then your supply of the building will be an exempt supply. If, in order to reclaim some VAT when you bought it, for some reason you decided to opt to tax, then it's important to remember that if you sell the freehold or a long lease, when you finish with the property, you'll need to charge VAT on that. Except, of course, if you sell it to a charity which is going to use it for non-business purposes, in which case your option to tax might be disapplied and you'll need to consider your VAT recovery position. And on the basis that the property was a capital goods scheme item over 250,000, if you sell it within 10 years of purchase, then that sale will have an effect on your original VAT recovery, and it will need to be adjusted. Whether that means you've now made an exempt supply of the building, or whether you've opted to tax and you're now making a taxable supply of the building, it's likely that you'll have to look back at what you did about VAT recovery on the purchase of the building, and also on any refurbishment projects over 250,000 within the last 10 years to see if any of that recovery has to be adjusted. And it could be good news or bad news. If you're making an exempt supply, you might need to pay some VAT back. If you're making a taxable supply, you might get some extra VAT recovery. And then just the final point on selling a property, and that's going back to the transfer of a going concern point, which I mentioned on buying a property. If you're selling a property as a going concern with a tenant sitting in it and you've got an option to tax, then as long as the buyer also opts to tax and the other conditions are met, then you might be able to sell the building without needing to charge VAT, which could be quite a big cash flow benefit. So over to John for the final corporate tax issues.
Thanks, Wendy. Yes, from a corporate tax point of view, again, it rather depends which entity has acquired the property in the first place and is owning the property. If it's a trading subsidiary, then clearly we're in a position where that is going to be subject to tax, but we have the ability to use gift aid to mitigate any chargeable gain. If it's within the charity, then we have an exemption for any chargeable gains. That exemption obviously is conditional on the fact that the proceeds are applied for charitable purposes, but I think in most cases one would assume that that condition would be met. There is a big however here with corporate tax on property disposals, and that is what I refer to as the overage trap. So very commonly you may find that a charity is disposing of its property, and we see this a lot in the education sector in particular, where properties are being disposed of to residential property developers. Residential property developers may well be in a position where they're able to negotiate as part of their price an overage, so that's effectively a slice of their development profit. For the purposes of the corporate tax rules, those overages, which are that sort of slice of the action, percentage of profit on the development, is actually not covered by the chargeable gains exemption, and it can be a very nasty surprise to charities who think they've done the right thing in negotiating a really good deal, but suddenly realise that they've got a big corporation tax issue further down the line. There are ways and means of dealing with that, again, usually involving trading subsidiaries and gift aid, but it's important that that structure is put in place at the point at which the sale happens in the first instance and the overage contract is negotiated. Otherwise, it can be a rather big corporation tax surprise for the unwary. Ben, I think you are now going to pick up some accounting matters.
Thank you, John. Thank you. Yes, I'm just going to talk a little bit about some of the kind of accounting issues for charities when it comes to property. So starting off, what types of property can we have in charities? Really, there's two main types. There's the functional property, so those properties which you use within your charity, maybe for your admin and actually running the charitable activities. And then the other type might be your investment property, so property which you've bought you've got primarily to either generate rental gains or capital gains, or a mix of the both, where the primary purpose is to generate funds. And then, of course, there is mixed use, which is sort of a property where maybe you've got functional property, but you've got extra space than you really need, so you rent some of that out as well. Then accounting for them. So we've got two treatments really for property. There's either holding at the historical cost convention, which is where we recognise it at the cost we paid for it, less a depreciation charge, recognising the use of the asset, or there's the market value, which is where every year the property is revalued to its current market value, normally on the way up, but obviously can have the dips up and down as we go. So what options have we actually got there? So investment properties, you have no options at all. It has to be held at market value. So every year the valuation needs to be updated. The functional assets, the assets which you're using within the charity, you do actually have a choice. You can either choose to hold it at market value and potentially strengthen your balance sheet, or you can choose to hold it at the historical cost. The warning on the historical cost or changing to the market value is, once you change to a market value, you have to stick with that every year. So you can't just think that the property market's had a good year, we're going to strengthen our balance sheet and then go back to holding at that cost. If you do go to that market value, you have to keep doing that every year going forward, which can attract some sort of extra professional fees to actually get that updated valuation. And then the next point on charities and property issues, I think is coming back to probably Ashley and charity shop sort of issues, so dilapidation provisions. So if you are renting shops in particular, or any property, there may be a condition of the lease that when you return the property to the leaseholder, you're going to have to put the property back in the condition you bought, you took it on in. So it might be that you need to replace carpets, you might need to redecorate, put some or remove alterations which you've made to those properties. So that can actually be quite a big cost. And what we don't want to do is get to the end of the lease and then have all of that cost hitting the expenditure in one go. So the requirement is to actually start recognising that cost over the value over the term of the lease. So yeah, particularly if you've got charity shops, that really could be quite a big charge to start working through, but it helps ensure that you don't have that nasty surprise when you come to the end of the leases. And then my final slide, just thinking a little bit about some sort of governance matters before Stephen's going to talk through some of the legal aspects of property, is actually if you are buying properties and you're going to do some refurbishment and there's some capital works to them, actually thinking about how you've got it structured in your organisation to monitor how those works go. Ordinarily, what I quite often see is at the outset, the board will be very involved. They will be signing off on the budgets. They will be agreeing the original purchase. But then as a project continues and maybe we get some variations and some unexpected bills, or the project doesn't quite go to plan, how are the board being kept up to date on this, and what is the requirement to keep them up to date? Really, it all comes back to the scheme of delegation and what the trustees have actually delegated down to the senior management team to have that decision-making powers. But I think it's important from a best practice that actually that is agreed early on. Everybody knows what sort of confines they're working to in, and that the board can be kept fully up to speed with how the projects are going, so that they as well don't get any nasty surprises at the end of the project. So that's my very quick kind of tour through that. So I'll now pass over to Laurie to go through some of the legal aspects.
Yep. So good morning. We're really delighted to be here this morning to provide you with an overview of the legal and regulatory compliance issues for charities in connection with land transactions. My name is Laurie Trounce. My details are there on the screen. I'm a partner and the head of the charity sector at Scown Solicitors. I regularly provide advice for charities in connection with a wide range of governance issues, including regulatory compliance matters. And this morning I'm joined by my colleague Tim Walmsley, who's also a partner in our real estate team, who has lots of first-hand experience of dealing with legal and practical issues faced by trustees in connection with the disposal or the mortgaging of charity property. So as part of our presentation this morning, we're going to be looking at charity property, providing you with a legal overview of how to identify what you have, which is obviously the first starting point, dealing with the legal constraints when you're dealing with charity land and why those legal constraints are in place. What are the risks if, unfortunately, and this happens from time to time, things go wrong, and then looking forward to future changes in the law. So as a starting point, then we need to be aware about the nature and the extent of a charity's property, and it's often the case that charities hold very valuable property assets. So understanding your charity's property position and arrangements is part really of an effective trustee induction, and you should be aware of how that changes over the course of any trustee's tenure. All resources of the charity need to be used in a way that the trustees reasonably believe will enhance the charity's objects. Now, in the most part, trustees will usually be left to their own devices and discretion as to how they demonstrate this. But when it comes to the selling, leasing or transferring of a charity's land and property assets, the law sets out clear requirements to ensure that these important transactions are being managed by trustees in the charity's best interests. In most cases, the legal framework actually allows trustees to dispose of land without Charity Commission approval, but we're going to be touching on those requirements during this part of our webinar this morning. So when we're looking at the statutory restrictions on land, they apply to three categories of charity, and we need to understand really what type of charity you are to understand what applies. So non-exempt charities, they are in the main registered charities, so I anticipate that this is many of you, whereas they don't always apply to exempt charities or charities which fall outside the scope of the Charities Act 2011, and they tend to be charities of an ecclesiastical nature. So the vast majority of charities are non-exempt charities, and therefore they're subject to the restrictions on disposals and mortgaging of land within the Charities Act. These are the areas that my colleague Tim Walmsley will be covering with you in a moment. But in terms of forms of charity, as many of you know, a charity is not a legal form or a type of structure. It's merely a status that's confirmed because of the activities that the charity carries out. And there are a number of different legal structures available to charities. And the most common ones are a company limited by guarantee, as a CIO, a charitable incorporated organisation, a trust, or an unincorporated association. And there are also some charities who are either regulated or incorporated by royal charter or statute. And it's that legal form which dictates really how charity trustees hold land and then potentially execute deeds or documents in relation to property transactions. And in this area, it's really important to draw the distinction between incorporated charities such as charitable companies and CIOs and unincorporated charities such as trusts or unincorporated charitable associations, because those incorporated charities are corporate bodies and therefore they have a separate legal identity, and they are able to hold assets and property. They're able to employ staff and enter into contracts and enter into other obligations and sue and be sued in their own corporate name. That's unlike unincorporated charities, where they're not separate legal entities in their own right, and therefore this means that the property is often held in the name of the trustees themselves. And one of the drawbacks of constituting a charity as a trust or an unincorporated association is the need really to cater for changes in the trusteeships and the holding of land over time following death or resignation of a trustee or the appointment of a new trustee. And therefore, from a practical perspective, it's often decide to appoint a holding trustee or a custodian trustee, such as the Charity Commission, or potentially hold the land on on trust for the charity. The alternative is potentially the incorporation of the trust body. This only relates to holding of property. It doesn't provide some of the other benefits to incorporation that the other structures such as a charitable company or a CIO offer, but it's another way of holding land to avoid those unnecessary changes to title documents over time. Now, regardless of the form of a charity, the majority of the provisions relating to land transactions apply to charity trustees, and the charity trustees are those persons who have general control and management of the administration of a charity, and that's defined within the Charities Act under section 177. And the charity trustees will not necessarily be the same as the owners of the property. So where you have a charitable company, it will be the company that will hold the property and not the trustees as owners. And for quite frequently, charity disposals, the charity trustees will be required to execute documents and provide certificates in their capacity as trustees. And the charity trustees' duties in relation to charity property come from the special or fiduciary nature of this relationship, as well as from the statutory charity framework and the nature of the charity's legal structure. And these are really helpfully summarised in the Charity Commission's guidance CC3, which is often known as the essential trustee. And for those of you that are familiar with the guidance, the infographic on my slide there will be very familiar to you. And these requirements require trustees to act responsibly, reasonably and honestly. And part of this is avoiding loss or damage or abuse of charity's assets, which includes its property. So from a charity trustee duties perspective, to avoid potential breaches of trust, you need to make sure that a charity's assets are only used to support its purposes, that you avoid exposing those assets to unnecessarily liability or reputational risk. You don't overcommit the charity, and some of the safeguards that my colleague in a moment will talk to you about is making sure that you've taken appropriate advice and that any commitments are repayable by the charity, and that you take care when you're investing or borrowing. And obviously as well, you comply with any restrictions on the spending of funds or selling of land, including a permanent endowment. That falls out the scope of this webinar. I think we could probably do 2 hours just talking about those areas, but please do take advice if your charity holds any assets on permanent endowment, including land. My colleague in a moment is going to deal with how these statutory responsibilities are approached in detail. But really, as a trustee, you need to know how your property is held and on what terms. You need to ensure it's maintained and correctly used. You need to ensure it's adequately insured, and that you take a regular check in terms of whether or not that property remains fit for purpose, whether it's still suitable, and whether or not it's still making a good return on investment if that property is being held for investment purposes. So really always check the charity's governing document for your charity's powers, and this may specify specific provisions in relation to the holding of land or buildings, and it also often tells you whether it's designated or specie land, as it's often called. But as I say, if there is permanent endowment land, it's best to take advice, because a separate set of rules in relation to dealings with such property will apply. Now I'm going to hand over to my colleague, Tim, who's going to talk you through some of those statutory provisions.
keeps jumping to mute. Sorry about that. We will continue on with what constitutes a disposal. The main examples are transfers or conveyances of land, granting of leases, assignments of leases, certain variations of leases, surrenders of a lease, grants of an easement, and the release and variation of a restrictive covenant. There is a query over options and rights of preemption, as whilst neither document constitutes a disposal, they will end up with a disposal if exercised, and therefore it's strongly recommended that these be treated as disposals. If you're in any doubt, then obviously please ask for advice. There are some clear transactions which are not disposals: licenses, tenancies at will, exercising a break right under a lease, and the vesting of land in a new trustee. Disposals are governed by the statutory procedure set out in sections 117 to 121 of the Charities Act 2011, and the basic procedure for all dispositions, other than the grant of a lease for 7 years or less not at a premium, is to obtain and consider a written report from a qualified surveyor. The surveyor must be a fellow or member of the RICS, and they must have the ability and experience of valuing land of the same type and in the same area as the land being disposed of. You must advertise a disposal following advice from your surveyor, or not if that is the surveyor's advice, and you should decide that you are satisfied that the proposed terms of the disposal are the best that can be reasonably obtained in the circumstances. You must comply with these requirements before you enter into any disposition or contract to do so. The procedure for 7 years or less, for leases at 7 years or less, not at a premium, is simplified. You must obtain and consider a report from someone who has the ability and experience to advise you competently and decide you are satisfied that the proposed terms are the best that can be reasonably obtained. This could be a member of staff. There are a number of exceptions to the statutory regime, and I will highlight the following. There are dispositions authorised by statute, dispositions of land to another charity for less than the best price reasonably obtainable, where the disposing charity has the power to make the disposition and the other charity's purposes are no wider than your own. Grants of a lease to a beneficiary of the charity without complying with the statutory regime are also permitted. An example would be where a housing association is letting property to its tenants for an affordable rent, which is less than the full market rent. Exempt charities also do not need to comply with the statutory regime. Disposals to connected parties require an order of the Charity Commission. In such cases, the Commission needs to be sure that you have taken the correct measures to manage any conflict. Connected parties comprise trustees of the charity and close relatives, donors of any land to the charity and close relatives, business partners of any of those persons, and institutions or companies controlled by any such persons in which they have a substantial interest. Just having a quick touching on acquisitions of land, there is no statutory regime that needs to be followed in relation to acquisitions. Trustees have a general duty to act reasonably and in the best interests of the charity, and this means they must take reasonable steps to ensure that there is necessary power and authority to acquire land, the property is suitable for its intended use, the price paid is a fair one, the charity can afford the acquisition, and the terms are fair and reasonable, and appropriate advice has been taken. It is recommended that trustees proposing to acquire land do seek professional advice before doing so. Moving on to mortgages. Mortgages of charity land has its own regime under the Charities Act, which is not dissimilar to that of the disposal of land. Before entering into a mortgage to secure a loan or grant, you must obtain and consider written advice from a person who has the ability and practical experience of financial matters and who has no financial interest in the grant or loan. This may be an officer or employee of the company, i.e. the financial director, and the person must advise on whether the loan is necessary for the charity to pursue the particular course of action that they require a loan for, whether the terms of the loan or grant are reasonable, and the ability of the charity to repay the terms proposed. Where the mortgage is to secure the discharge of another obligation, trustees must obtain advice on whether it is reasonable for them to undertake to discharge the obligation having regard to charitable purposes. If the mortgage provides for further advances, then similar advice must be taken before securing those further advances. I'm now going to hand back to Laurie for the next slide.
Thanks, Tim. So what happens when trustees get it wrong? I've just summarised some cases here. The first is the Bayomi decision back in 2003, and this really sort of a contract for sale could be rendered void if those Section 119 duties were not followed, and therefore essentially the trustees had no power to enter into the documents which they had entered into. But that was later sort of re-clarified, and perhaps it's a bit greyer now insofar as it's a further case of David Roberts Art Foundation and Nicole Marlene Riedeweg, and we'll circulate some details of these cases so that you could follow them up at your leisure if you so wished. But essentially in this case, a charity sought to enforce a contract of sale for some of its land, and the court held that relatively minor failures to comply, in this case it was the inclusion of the statements in a draft transfer that was annexed to the contract for sale rather than in the contract itself that caused problems, and obtaining a surveyor's report a bit later than was envisaged by the regime were not sufficient of themselves to render the disposal ineffective. But it was acknowledged in that case that in relation to surveyors' reports, there might be such a degree of non-compliance that in effect they couldn't be categorised as relatively minor failures, and therefore they should still be able to rely on the work that they'd undertaken. So it's quite clear that there is a differing approach, which is very, very fact specific. And so the best approach is to secure full compliance is to make sure that you work your way through the statutory regime and use the provisions in Section 119 that my colleague has summarised as a kind of checklist, an aide-memoire, because they should be carried out in the order that they're set out within the statute itself. And then finally, just to mention the Spiritualist Association of Great Britain. This is one where John mentioned in his presentation about overage. The charity sought to sort of make a transfer or dispose of this property on 2 occasions, and they failed to take proper due diligence work in situations, and essentially the properties ended up being sold for £6 million, but later were sold again for 21 million. And the Charity Commission took obviously a keen interest in whether or not the trustees had fulfilled their duties under Section 119, and they held that in this case the trustees hadn't followed the procedure as they should have, and where they had taken advice, it was either disregarded or they failed to take it into account properly, and as a result they failed to achieve the maximum return from the property disposal. And the Commission held that these failures and breaches were not minor or technical in nature, and they couldn't be avoided. They could have been avoided and they couldn't be ignored or passed over due to the outcome in this particular case. And they made a finding of serious mismanagement against the trustees. Although in this case no further action was effectively taken, there were a variety of mitigating factors. Clearly, this might not be this might be very different if the facts were, on a different set of facts. So I think charity trustees are aware can take an active interest in this area and will commence statutory inquiry proceedings where it feels that the charity trustees have failed to discharge these duties. Just moving on now back to Tim, and Tim's going to share with us some of the impacts of COVID-19 on the legal position and also forthcoming legal developments.
Thanks, Laurie. COVID has obviously had a significant impact on the charitable sector. Cash flow has been a key issue, with funding streams having been significantly impacted. There have also been concerns around the ability to pay rent or receive rent on investment property. This has led to trustees reviewing priorities and spending, assessing the financial viability of charities, considering the use of reserves, looking at external funding opportunities, and looking at opportunities to merge and collaborate with other charities. Just moving on to future changes in the law, in September 2017, the Law Commission republished a report on technical issues in charity law, which analysed various current issues and made recommendations that the law should be reformed. In March this year, the government's response was to accept the majority of the Law Commission's recommendations. This was followed by the announcement of the Charities Bill in the Queen's Speech, which proposed several technical but important changes. The first is the ability to amend governing documents more easily. The second was access to a much wider pool of professional advisors on land disposals. There is also a proposal for more flexibility to make use of permanent endowments. There is a change that trustees will be able to be paid for goods provided to the charity in certain circumstances. And lastly, charities will be able to take advantage of simpler and more proportionate rules on failed appeals. The new bill is currently in draft form, and we will await further information and updates about the schedule for implementation from the government. I will now hand back to David.
Thank you very much, and hopefully you can hear me. It seems to be somewhat beset with a few technical challenges today, so my screen is telling me I'm muted, but I'm seeing that it looks like you can hear me. So yeah, just like to thank all the speakers for everything they've contributed. I'm conscious we're a bit short of time. We've got a few questions that have come in, so I will. We'll have a sort of 5 minutes or so of Q&A before we wrap up. So the first question is quite a specific one, which suggests someone's been a little bit burnt by this. So it's a question for Stephen Scown. So it says guidance CC28 says that when granting a lease, we should be able to take back possession of the land at the end of the lease, e.g. by opting out of the Landlord and Tenant Act. Is opting out just guidance, or is it a requirement? I don't know whether that's one for you, Tim, or you, Laurie.
Yeah, I'll pick that one up. That is guidance. It's not a set rule. It obviously depends on really what the charity sees as being its future. It's probably recommended as guidance because obviously then it gives you an opportunity to walk away at the end of the lease fairly easily. But obviously then it probably makes the lease a little bit less valuable if you, during the term of the lease, ever wanted to assign it or move it on. So really it's one to be considered with your professional advice at an early stage before the lease is taken out.
Okay, thank you. I've got a question here for John, which is, can you explain a bit more about why having a property owned by a trading subsidiary causes problems with gift aid?
Yep, absolutely. So it's all down to the interaction of depreciation and capital allowances. So the company, the trading subsidiary company, if it owns property, will have a requirement on it to depreciate that property. Depreciation is a non-tax allowable deduction. So that would get added back in the tax computation, and then tax has its own set of equivalent rules, which are obviously capital allowances, and with the best will in the world, it's very difficult to get depreciation and capital allowances to equal the same number, because they're written under two different sets of rules, accounting and tax respectively, and especially if you've got property. Appreciate now we have the structures and buildings allowance at 3%, but traditionally property depreciation is completely just non-deductible and there's no equivalent capital allowance. So you either get basically a permanent difference in the accounting and tax profit, or best case scenario, some sort of timing difference. And that obviously then creates a difference between your accounting distributable profits, and which you need to have in order to pay a gift aid donation, and your tax profits that you need to cover with gift aid. So essentially, that issue around depreciation and capital allowances prevents gift aid from working as efficiently as it could, because you can't guarantee that you've always got the distributable profits in the trading subsidiary. And if you want that trading subsidiary relationship to work as tax efficiently as possible, usually best to have the property in the parent charity. Obviously, there may be commercial reasons why you want to have the property in the trading subsidiary, and obviously in that situation, if that overrides the tax, then obviously that needs to be worked through and modelled to look at how it can work, and it can be made to work, but it's just an extra complication that's usually best avoided if possible.
Okay, thanks, John. And one last question, a quick one for Ashley, to do with cladding. So cladding seems to be a residential issue, but can it also be an issue for the office and retail sectors? Is that something that charities should be concerned about?
It hasn't come through in any of the RICS guidance yet, but yes, I think it's inevitably going to snowball. The building regulations, as I understand it, and I'm not an expert in the EWS1 form, the implementation has been residential because of the high risk and the compartmentalisation issues and the lack of fire breaks and flammable cladding. But internally, from the work that we are seeing so far, and those buildings which we've been involved in as a firm, yes, I suspect that cladding issues are on their way through the buildings. There is this 12 and 18, sorry, the 18-metre rule, so it's not going to impact on all buildings, but it's and I suspect there will be a slightly different regime in the office market due to the fact that fire is managed differently in commercial buildings. But yes, I think it's a good question. I suspect that the cladding issue won't stop at residential.
Thank you. Right, so that's all we've got time for. So it just remains me to thank all the speakers today for all their contributions. I mean, certainly the one takeaway I've got is, I mean, clearly the property sector with charities is a pretty complicated minefield. So certainly, if you are planning on any transactions, then taking professional advice does seem like a pretty good place to start. And where better than Bishop Fleming or Stephen Scown or Bruton Knowles. So just thank you once again for joining us. As I said at the start, we will send out some documentation after this, so there'll be the obligatory feedback form, but also a recording, which I'm conscious that there were a few technical issues, so the recording will hopefully solve those. So thank you very much, and I look forward to seeing you again in the future.